Hey everyone, and welcome to our BlackRock Global Outlook Q4 update for September 2025. I'm excited to share the latest insights from the Investment Institute, outlining our perspectives on the global economy and markets as we head into the final quarter of the year. Staying pro-risk through April's volatility worked well. As we highlighted in our previous outlook, equities across the world demonstrated remarkable resilience, rebounding sharply from the tariff-driven plunge we observed in April. Our conviction was that immutable economic laws would ultimately temper any maximalist stance on tariffs and policy, thereby setting the stage for a significant market recovery. Please look at the chart titled Regional Equity Performance 2025. You can clearly see how after a dip around April, the index levels for all regions, China, US, EM, Japan, UK, and Euro area, show a strong upward trajectory, with many surpassing their early year highs by September. This visual evidence underscores the effectiveness of maintaining a pro-risk posture through that period of volatility, as our thesis played out. Pressure builds on long-term bonds across developed markets. We're observing a significant shift where long-term government bond yields are under renewed pressure, primarily driven by escalating fiscal concerns that have become a much larger market driver. This is particularly evident in Japan, France, and UK, where yields have surged to multi-decade highs. Let's examine the charts. On the left, 30-year government bond yields 2000-2025. Notice the sharp upward movement in yields for UK, France, Italy, and Japan, especially in the latter part of the period, reaching levels not seen in many years. This trend is further contextualized by the chart on the right, debt to GDP ratios 1970 to 2030. Here, you can see the projected increase in debt to GDP ratios for major economies, with several countries, including the US, France, and UK, approaching or even exceeding the US post-World War II peak. This persistent rise in government debt levels is a key factor contributing to the upward pressure on long-term bond yields, as investors demand higher compensation for increased fiscal risk. Bonds are responding unusually to the Federal Reserve's cuts. We've seen a peculiar dynamic where the U.S. yield curve has steepened even as the Fed has initiated interest rate cuts. Our analysis suggests that market attention is shifting away from policy-driven uncertainty and is now more focused on the inherent tension between fighting inflation and containing government debt. Let's look at the chart on the left, U.S. 30 and 10-year yield curve in Fed cutting cycles. Observe the red line, representing the 2024 cutting cycle. Unlike previous cycles, particularly the gray lines from 1984 to 2019, the spread between 30 and 10-year yields has not inverted or flattened significantly. Instead, it has steepened. This is an unusual response. Now, turn your attention to the right-hand chart, U.S. federal debt and interest costs 1970 to 2035. The solid yellow line, representing net interest cost as a share of total outlays, shows a dramatic increase, especially from 2020 onward, projected to continue rising significantly. This surge in interest costs, alongside the rising federal debt held by the public, the orange line, highlights the fiscal constraints. The market's focus on this growing debt burden and its implications for long-term inflation and solvency is, we believe, overriding the typical yield curve response to Fed rate cuts, leading to this unusual steepening. Let's move on to our 2025 outlook themes, which guide our investment strategy. First, investing in the here and now. We believe that immutable economic laws limit the pace at which global trade and capital markets can evolve. This provides greater certainty about the near-term macro outlook compared to the long-term. Consequently, we remain pro-risk and maintain an overweight position in U.S. equities. Second, taking risk with no macro anchor. This transformative environment, in our view, offers better opportunities for achieving above benchmark returns, or alpha, than the prior decade. However, the volatile macro environment injects significant risk into portfolios, necessitating active management or neutralization to capture these opportunities effectively. And third, finding anchors in megaforces. Despite the loss of traditional long-term macro anchors, we firmly believe that megaforces are durable drivers of returns. These forces, however, don't neatly translate into broad return drivers, requiring us to get granular in tracking their evolution across and within asset classes. A prime example of a theme we favor is artificial intelligence, which we see as a powerful and enduring driver. The AI megaforce is offsetting a consumer spending slowdown. We're seeing resilient investment from companies into artificial intelligence-related infrastructure, which is actively propping up U.S. economic activity. This trend clearly demonstrates how megaforces are becoming the new anchors for today's economy and are driving returns. Let's look at the charts. On the left, contributions to annual U.S. GDP growth 2000 to 2025 focus on the non-residential investment component, represented by the dark green bars. Notice its significant and growing contribution to GDP growth in 2023, 2024, and particularly in the first half of 2025, even as consumption, the yellow bars, show signs of moderating. Now, turn your attention to the right-hand chart. Annual change in U.S. non-residential investment. The orange bars represent AI-related software and AI processing equipment investment. You can see a substantial and accelerating increase in this component, especially from 2022 through 2025. This strong growth in AI-related investment is a critical factor, visually evident in these charts, that is effectively counteracting the broader consumer spending slowdown and sustaining overall U.S. economic activity. Goods prices are rising again in the wake of U.S. tariffs. While overall inflation has shown some moderation, we're observing a sharp rebound in goods inflation, especially in areas where prices had been falling after spiking during the pandemic. We believe this is a direct impact of tariffs beginning to feed through, especially in highly imported goods like appliances. Let's examine the charts. On the left, U.S. core PCE goods inflation 1980 to 2025, observe the red line. After a significant decline post-pandemic, it has recently turned upward, reaching 2.61% in July 2025, moving above the 1995 to 2019 average. This indicates a clear reacceleration in goods prices. Now look at the chart on the right, U.S. CPI inflation 2020 to 2025. Focus specifically on the yellow line, representing appliances. You can see a dramatic spike in appliance inflation in 2025, far outpacing other categories like autos or recreation. This sharp increase in appliance prices, a highly imported category, provides compelling evidence of tariffs translating into higher consumer costs, confirming our view that goods inflation is indeed rising again. Unpacking the U.S. inflation puzzle. Services inflation, after slowing earlier this year, has firmed up in recent months. We are closely monitoring whether weaker economic activity will lead to a sustained drop in services inflation or if it will remain sticky. Let's look at the charts on the left. U.S. core services and wage inflation, 2018 to 2025. Observe the red line, representing wages, and the yellow line representing core services ex shelter. Both lines show a noticeable firming trend in recent months, indicating that wage pressures and broader services inflation are proving persistent. Now turn your attention to the right-hand chart, monthly change in U.S. payrolls 2022 to 2025. The solid black line, which is the 3-month average, shows that payroll growth has been moderating. However, compare this to the dashed black line, which is our estimate for the break-even rate assuming pre-pandemic migration. The actual payroll growth is still above this break-even rate, suggesting that the labor market, while cooling, may not be softening enough to significantly alleviate wage and services inflation pressures. The green line, representing payroll growth consistent with slowing population growth and elevated migration, offers a slightly higher break-even, but the overall picture still points to a relatively tight labor market. Mapping out Fed policy outcomes and market implications. This framework helps us visualize the various plausible outcomes for Fed policy and their market implications. Let's walk through the quadrants. In the top left, we have high for longer interest rates, characterized by resilient growth but limited fiscal flexibility, forcing the Fed into a tough trade-off. Here, tech earnings drive equity gains and term premiums rise. In the top right, Fed independence questioned, also with resilient growth, we see term premiums in long-term bonds rising and stocks gaining as growth and earnings hold up. This scenario implies a challenge to the Fed's autonomy. In the bottom right, recession fears dominate, we would see stocks fall, bonds gain, and the AI theme potentially holding up. This is a scenario of excessive easing leading to a downturn. The bottom left, an unlikely outcome unless inflation resurges, represents a scenario where inflation unexpectedly re-accelerates, leading to a very difficult policy environment. Our baseline, however, is the lucky alignment in the middle. This scenario anticipates equity gains broadening beyond the AI theme, yields falling as the Fed cuts rates due to a softer labor market, and fiscal concerns easing temporarily. This is the path we see as most probable, balancing growth and inflation dynamics. Markets have swung back to expecting more Fed rate cuts. After a period where markets were barely pricing in a single quarter-point cut through to the end of 2026, we've seen a significant shift. Markets now anticipate the Fed cutting rates to around 3% by next December. Let's look at the chart. Actual and market-implied Fed funds rate 2024 to 2025. The solid red line shows the actual Fed funds rate, which has been stable at a higher level. Now, focus on the yellow line, labeled "and 2026." You can clearly see that this line, representing market expectations, begins to decline significantly from its current levels, projecting a path towards approximately 3% by the end of 2025. This downward slope in the yellow line is a direct reflection of the market's renewed conviction that the Federal Reserve will implement a series of rate cuts over the coming year, a notable change in sentiment from just a few months ago. Tech earnings underpin U.S. equity returns so far this year. AI-linked sectors and companies have been exceptional, delivering strong earnings that have primarily driven U.S. equity returns year to date. Beyond the U.S., however, returns have largely been fueled by rising valuations rather than earnings. Let's examine the charts. On the left, U.S. equity sources of return 2025 focus on technology and communications and the Magnificent Seven. You'll notice that the orange portion, representing earnings, is the dominant contributor to total return for these categories, indicating robust fundamental performance. In contrast, for broader indices like the S&P 500 equal-weighted or Russell 2000, the yellow portion, representing valuation, plays a more significant role or total returns are lower. Now, shift your attention to the right-hand chart, Regional Equity Sources of Return 2025. Observe the bar for U.S. Here again, the orange earnings component is a substantial driver of total return. However, if you compare this to regions like China or emerging markets US dollar, you'll see that the yellow valuation component often contributes more significantly to their total returns, or their total returns are lower, underscoring the unique earnings-driven strength of US tech this year. We think earnings, not valuations, will drive equities higher. Traditional measures often suggest that U.S. equity valuations are currently above average. However, where these valuations ultimately settle will largely depend on how the ongoing economic transformation plays out. Our core belief is that AI-led productivity gains have the potential to significantly boost earnings growth, which will be the primary driver of higher equities. Let's look at the charts. On the left, U.S. tech equity valuations and earnings 2007-25. Each dot represents a monthly observation of the 12-month forward price earnings ratio against the following 5-year earnings growth. The dashed black line indicates the current U.S. tech valuations, which is on the higher side of historical observations. However, the scatter plot shows that periods of higher P/E ratios have at times been followed by strong earnings growth. Now, turn to the right-hand chart. U.S. equity 5-year earnings growth 1875-2025. This histogram illustrates the frequency of various ranges of 5-year annualized earnings growth. Notice that the average growth rate is 4.7%, but there are numerous instances where earnings growth has been significantly higher, with a notable frequency of at least 15% earnings growth over a 5-year period. This historical context, combined with the transformative potential of AI to drive productivity, supports our view that future earnings growth, rather than just current valuation levels, will be the key determinant for higher equity prices. The case for a scenario-based approach. We believe that the current economic environment presents multiple, plausible long-term outcomes, reflecting an ongoing tug-of-war between various forces. We don't think these outcomes are sufficiently captured by a single distribution, which is why we employ a scenario-based approach to better inform our strategic views. Please look at the chart, illustrative distribution of U.S. equity returns in different hypothetical scenarios. The central grade distribution represents the starting point scenario, which captures many other scenarios captured by existing distribution. However, we also identified distinct, alternative scenarios that are underrepresented by starting point. For instance, the pink distribution on the right, labeled Artificial Intelligence Productivity Boom, illustrates a scenario with significantly higher returns driven by AI. Conversely, the yellow distribution on the left, higher risk premium for U.S. assets, depicts a scenario with lower returns due to increased risk perception. The uncertainty band in light green highlights the range of outcomes around the starting point. By considering these diverse yet plausible scenarios, we gain a more robust understanding of potential market paths, allowing us to build more resilient portfolios that can navigate a wider range of future realities. Greater potential alpha on offer. The precise effect of tariffs on earnings will vary significantly between companies and regions, and this dispersion could create substantial opportunities across stocks. We believe this is a prime example of how investment skill may be better rewarded in today's market environment. Let's look at the charts. On the left, U.S. import duty receipts June 2025 versus December 2024. Observe the change in duty receipts for various categories. For instance, machinery and electrical shows a substantial increase from $1.7 billion in December 2024 to $6.6 billion in June 2025. Similarly, transportation and metals also show significant increases. This growing disparity in duty receipts across sectors implies varying impacts on corporate earnings, leading to greater dispersion. Now turn your attention to the right-hand chart, U.S. Equity Fund Managers Excess Returns 2010-2025. Compare the performance of the top quartile managers and the median manager between the 2010-2019 and 2020-2025 periods. Notice that for top quartile managers in 2020-2025, the red portion, representing alpha, is significantly larger compared to the earlier period and to median managers. This indicates that skilled managers have been able to generate substantial alpha in the more recent, volatile environment, reinforcing our view that increased market dispersion creates a richer hunting ground for active management. A world financed by private markets. We foresee an expanding role for private markets across all three of our scenarios, as an increasing number of companies rely on private markets to meet their financing needs. Concomitantly, smaller companies are increasingly being crowded out of public credit markets as deal sizes continue to rise. Let's examine the charts. On the left, average U.S. company age at initial public offering. Observe the clear upward trend. The average age of a U.S. company at its initial public offering has steadily increased from 8 years in 2004 to 11 years in 2014 and further to 14 years in 2024. This indicates that companies are staying private for longer, maturing significantly before entering public markets. Now, look at the right-hand chart. Average deal size in high-yield debt, 1995-2025. You can see a consistent and substantial increase in the average deal size for global corporate high-yield issuance over this period, with a particularly sharp rise in recent years. This growth in deal size in public credit markets makes it harder for smaller companies to access financing, pushing them toward private capital. Both charts underscore the growing importance and dominance of private markets in corporate financing. We see future portfolios building around private markets. Companies of all sizes are increasingly tapping private capital today, leading to an overlapping opportunity set between public and private markets. We believe that private market allocations should become more granular to account for this evolving landscape. Let's look at the diagram. Private market financing by company size. On the left, we have options available to large companies only, such as public equity, public debt, commercial paper, and syndicated loans. Notably, the number of listed U.S. companies has halved since 1996, highlighting a shift away from public equity from many companies. On the right, we have options available to both large and small companies, which include private equity and joint ventures. Below that, we see private credit, encompassing direct lending, mezzanine debt, and private placements. The assets in private credit and average deal size have doubled since 2019, demonstrating its rapid growth and importance. Finally, venture capital is primarily for small companies. This visual breakdown illustrates the expanding universe of private market instruments and the increasing overlap with traditional public market functions, emphasizing the need for a more sophisticated approach to portfolio construction that integrates both public and private allocations. Let's turn to our big calls for 2025, outlining our highest conviction views across both tactical, which is a 6 to 12 month horizon, and strategic or long-term horizons as of September 2025. On the tactical side, for U.S. equities, we acknowledge that policy uncertainty may weigh on growth and stocks near term. However, we believe U.S. equities can regain global leadership supported by megaforces like AI. For using FX to enhance income potential, FX hedging is now a potential source of income, particularly when hedging euro area bonds back into US dollars. For risk-taking strategies, we advocate for deliberate risk-taking to earn alpha. This includes navigating regulatory changes impacting corporate earnings, identifying crowded positions prone to snapbacks, and seizing opportunities to provide liquidity during stress periods. Moving to our strategic calls, for infrastructure equity and private credit, we see opportunities in infrastructure equity due to attractive valuations and megaforces. Private credit is set to gain lending share as banks retreat, offering attractive returns relative to public credit risk. For fixed income granularity, we are overweight short-term inflation-linked bonds, anticipating U.S. tariffs could push up inflation. Within nominal bonds, we favor developed market government bonds outside the U.S. over global investment-grade credit given tight spreads. Lastly, for equity granularity, we favor emerging market over developed market stocks, being selective in emerging markets via megaforces. In developed markets, we particularly like Japan. Now let's review our latest strategic views, presented as hypothetical US dollar 10-year strategic views versus equilibrium as of September 2025. We are going overweight developed market government bonds and have shifted to an underweight position in global investment-grade credit due to tightening spreads in Q2. Looking at the table, under DM government bonds, we maintain an overweight stance of +1, with a constructive view on non-US bonds. For emerging market equity, we are also overweight at +1, with a constructive view on India. Inflation-linked bonds remain overweight at +1. Mortgage-backed securities are neutral. We are underweight in developed market equity at -1, with a neutral view on IT, healthcare, and energy sectors. Moving to the right side, DM high yield and EM debt is neutral. Income private markets are neutral, with a constructive view on infrastructure equity and a cautious view on U.S. core open-ended real estate. Finally, we are underweight in global IG credit at -1 and underweight in Chinese government bonds at -1. These positions reflect our conviction in a diversified approach, favoring specific areas of value and growth while navigating potential risks. This slide provides a visual representation of our latest strategic views, breaking down our hypothetical US dollar 10-year strategic views versus equilibrium for September 2025. We continue to be overweight developed market government bonds and have shifted to an underweight position in global investment-grade credit due to tightening spreads in Q2. The top section, equity-like holdings, illustrates our allocations across developed markets, including US, Europe, Japan, and other, as well as growth private markets, real estate, and emerging markets. This visual helps to convey the relative weightings and diversification within our equity-oriented exposures. The bottom section, income-like holdings, details our positions in developed market government bonds, segmented into non-US long-term, non-US short-term, U.S. short-term, inflation-linked, and U.S. long-term, along with credit components like U.S. mortgage-backed securities and investment-grade credit. We also include income private markets such as direct lending and real estate mezzanine. This comprehensive view underscores our balanced approach, seeking opportunities across both equity and income streams while managing risk effectively. Let's delve into our tactical granular views, equities, providing our 6 to 12-month tactical views on selected assets against broad global asset classes by level of conviction as of September 2025. For developed markets, starting with the United States, we are overweight. Policy-driven volatility and supply-side constraints are pressuring growth, but we see AI supporting corporate earnings, and U.S. valuations are backed by stronger earnings and profitability relative to other developed markets. For Europe, we are neutral. Greater unity and a pro-growth agenda could boost activity, but we're watching how the bloc tackles structural challenges. We note selective opportunities in financials and industries tied to defense and infrastructure spending. The UK remains neutral. Political stability could improve investor sentiment, but an increase in the corporate tax burden could hurt profit margins. For Japan, we are overweight, given the return of inflation and shareholder-friendly corporate reforms. We prefer unhedged exposures as the yen tends to strengthen during market stress. Moving to emerging markets, we are neutral. Valuations and domestic policy are supportive, but geopolitical tensions and global growth concerns keep us sidelined. Finally, for China, we are neutral. Trade policy uncertainty keeps us cautious, and policy stimulus is still limited, with structural challenges like an aging population persisting. Now let's review our tactical granular views. Fixed income, covering our 6 to 12-month tactical views as of September 2025. For short U.S. Treasuries, we are neutral, viewing them akin to cash in our tactical views, and have removed our previous overweight to turn neutral on long-term Treasuries. Long-term Treasuries are also neutral. Yields could fall further if a softening labor market allows the Fed to cut rates without questioning its independence. Global inflation-linked bonds are neutral. We anticipate higher medium-term inflation, but cooling inflation and growth may matter more near-term. For euro area government bonds, we are neutral. Yields are attractive and term premium has risen closer to our expectations relative to U.S. Treasuries, with a preference for peripheral bonds like Italy and Spain. UK gilts are neutral. Gilt yields are off their highs, but the risk of higher U.S. yields impacting the UK's fiscal space has risen. We are underweight Japanese government bonds as we see room for yields to rise further on Bank of Japan rate hikes and a higher global term premium. China government bonds are neutral. Bonds are supported by looser policy, but we find DM short-term paper more attractive. We are overweight U.S. agency MBS, finding income compelling and preferring them to U.S. Treasuries for high-quality fixed income exposure. Short-term IG credit is overweight, as short-term bonds better compensate for interest rate risk. We are underweight long-term IG credit due to tight spreads, preferring equities and favoring Euro over the U.S. Global high yield is neutral. Spreads are tight, but corporate fundamentals are solid, making total income attractive. Asia credit is neutral. We don't find valuations compelling enough to turn more positive. We are underweight EM hard currency, as spreads to U.S. Treasuries are near historical averages, and we find local currency EM debt more attractive. Finally, EM local currency is neutral. Debt levels for many EMs have improved, and currencies have held up against trade uncertainty, with a preference for countries with higher real interest rates. This slide provides an overview of the BlackRock Investment Institute. To access more of our insights and content, please visit blackrock.com/BII. Thank you for listening. Don't forget to subscribe so you never miss our latest episodes. We'll see you next time.